Good morning and welcome. Thank you for coming and thank you for dialing in. My name is Martin Schmalz and I'm the Chief Economist and Director of the Office of Economic and Risk Analysis. It's a privilege and I'm humbled and feel honored and grateful for the opportunity to welcome you to this year's PCAOB Conference on Auditing and Capital Markets. Thanks to the hard work of Rasan Inget and Zhang Yan, who are in the back, as well as an entire team of PCAOB staff that you met outside already. We have an exciting program ahead of us. The program features some of the best and most accomplished scholars of accounting and auditing, audit practitioners, as well as our own PCAOB subject matter experts, as well as directors of various offices and divisions at the PCAOB. And I'm especially excited that this year we have an investor panel as well, and I look forward to listening to them and learning from their perspectives. Of course, we also have Kartik Ramana, my own colleague from Oxford, and I don't want to stand between you and all of this exciting stuff for very long, but I did want to share one story with you to start. I want to tell you how I came to join the PCAOB and why I think many of you should come and work with us as well. So when I was approached for this job, I read the mission statement. And in particular, I read that the mission involves protecting investors and further the public interest in the preparation of informative, accurate, and independent audit reports. And I thought, whoa, how can capital markets even function without this? No? And how can capitalism, and so how can we attempt to create value without that important function? So it just seemed incredibly important to me. And then I learned that the work we do affects more than $50 trillion worth of equity market cap of the issuers for whom the audits are prepared. So I thought to myself, look, what's going to be more likely to get you out of bed in the morning for the near future? Write another paper and try to convince referee number 2 that table 5 is really, really important and should stay in the paper, or help design what I think of as part of the governance mechanisms that might just help create even a small fraction of $50 trillion worth of additional wealth for society. And so I did the math, and the result, I must admit there was appeal to the second option. But besides that, the PCAOB is just a gold mine of data. No? That is incredibly valuable for research. And obviously, anything that affects $50 trillion of wealth is important. So I thought to myself, how could journal editors possibly refuse to publish studies that come out of this place? I hope the journal editors are listening. So I figured the paper writing and doing impactful work comes together hand in hand at this place. So that's when I decided to join these guys and decided to join the PCAOB. Now, I want to invite you to do the same and come work with us in one capacity or another. There's many ways of working with us. I'll introduce 2 of them in just a moment, but there's also others that we're in the process of creating, and of course there's just informal collaborations as well. But what I want to tell you is that if you join, from my experience, you'll have a great time. Coming here, I found a team of very smart and mission-focused individuals that are eager to work and really jump on the occasion. And individuals that, in addition, just are exceptionally nice and friendly people that treat each other like family, literally. So I can't tell you how enjoyable the first few weeks have been thanks to that and the warm welcome by the OIRA team and the PCAOB more broadly. So the support I received even before joining from Mike Gerbert, and after that from the entire organization, was really touching. And in the last days in the preparation for this conference, especially from Rasan and Zhang, as well as from Harsha, who will speak to you shortly, and David Colino, that support has been incredible. So Team OIRA, I can't thank you enough for the support and the loyalty you've shown in the past few weeks. It's been a great experience. Thank you very much. And I'm sure the audience shares my gratitude for what you all set up here for the day at the conference. But before we move on to the program, I was asked to tell you about a few housekeeping items. I want to just state the usual disclaimer that on behalf of myself, but also all other PCAOB staff, any views expressed are our own and do not necessarily reflect the views of the board as a whole, individual board members, or any other staff. And as a reminder, to obtain CP credits, you have to use your smartphone to scan the QR code that was up there in the beginning and will be before every session. And check in with your full name and email address at the start. And after each panel, please remember to perform the evaluation. As another disclaimer, this conference is being recorded, and the chat function starting with panel 1 will be public and visible to all attendees. So thank you for that. Then I promised I'll give a few pointers on how to come work with us. We have the Academic Fellows Program. Many former fellows that successfully published studies based on it are in the room. And we are again seeking applications for the next academic year. Right now, there are two types of positions. One is 100% staff work, so this is not a research-focused program. And the second one is part staff work and part independent research with the aim of developing publishable papers. And if you want to apply for that position, we're interested in a research proposal as well. But also, just come and chat with us for a start and see where it goes. As you'll see in my presentation later on, I think there are many audit-related research questions that don't actually require internal PCAOB data and that are very important as well. I think there are some ready-to-go research designs sitting in UERA and eager collaborators. So feel free to reach out and we'll set something up. So I wanted to take the next half hour or so to offer some thoughts on the talent pipeline and how it might be connected to the trends in audit quality that Harsha introduced and Erika referred to as well. And then I hope I get to the last slide, which offers a set of other research topics that I believe should be interesting both for our work and to academic audiences as well. Again, as I said previously, the views are my own. But whereas the views are my own, the presentation was not done by myself all alone. Especially I want to highlight David Colino and Harsha for helping me the last few days in a last-minute dash, as well as others on the legal team to get this presentation through. Thank you very much. So what I want to think about is which theories can potentially jointly explain the concurrent trends of declining audit quality as measured by audit efficiency rates and what we read about in the newspapers as the talent crisis. And last week had a conference about here in DC, of course. So I'm not going to be able to answer these questions, but I want to offer a framework and think about which theories we can test against each other with the available data and which ones remain open research questions and try to motivate why I think they're important. And as I said, then get to additional research questions. So recalling fun fact number 1 is the decrease in auditors, or the entrance pipeline anyways. And of course, there's a question as to whether a change in composition of the audit teams could help explain the decline in audit quality. Harsha introduced this fact as well, that for the last decade really before the pandemic, there was a long downward trend in deficiency rates, bottoming at 2020, and Harsha mentioned that it was broad-based across the various firms. It is true in the US firms and global network firms, so it's really broad-based. It's not isolated to a particular subset. But then, with the first season of inspecting audits that were prepared during the pandemic, so presumably online, there's an uptick. Erika mentioned you cannot find this data point on the website, but we have made it publicly available, the staff estimates for the next season. This trend indeed continues. Okay, so this is not just one blip up, but the trend is expected to continue. Now look, the talent crisis talk and the declining audit quality, they correlate. I think that's interesting. Now look, lots of things correlate in the time series, so I don't want to overdo that. We don't have limited data to measure cross-sectional correlations, but I think it might still be attractive to think of a joint explanation for these time trends. Done. I might need more help, or maybe you can just click me through. If you can click to the next slide. Anyways, the laser works. I don't know. That was not me. Wonderful. And back we are. So I refer to the talent crisis, that it is how it is described in the press. Sometimes some people call it the talent shortage. You saw it in the Wall Street Journal over the last few weeks. So they're full of headlines about how accountants don't want to work in the profession anymore, citing other available options. Even accounting majors don't want to do accounting jobs and so forth. Now, when I read this, the sense I get is that the common narrative is what economists would call labor supply explanations. So in non-economist speak, people just lost the taste for work in accounting. Now, what rubs me the wrong way as an economist about this narrative is clearly what we're seeing is some sort of equilibrium phenomenon. And it's not clear that we held demand constant, right? So labor demand, the demand for auditors. So all we know is that fewer people want to work in auditing given the wages firms choose to offer, right? And that is what I want to tease apart, whether it's actually a demand or a supply explanation. Now, let me get a little technical here, right? So we've all seen demand and supply diagrams at some point during our education, and there's a competitive point. There's a quantity of auditors demanded in the labor market for auditors, and there is a market price, that's the wage for auditors in a competitive market, all right? Now, the supply story we see in the newspapers is, well, fewer accountants want to work at a given wage in accounting. So in this diagram, that would mean that curve moves to the left, so we get a new intersection of the new supply curve with the demand curve, and that happens at a lower quantity. So yep, that makes sense. That could explain decreasing numbers of accountants. But it also makes a prediction about the new wage levels. Okay, so wage levels would be a lot higher. How much higher, that depends on the slope of the demand curve. And I'll go back to that point shortly. My point here is that there's another theory that would explain a reduced quantity, and it is a decrease in labor demand. If for a given level of wage, firms just don't want to hire as many auditors anymore. Well, that also explains why there's a lower quantity, but it makes the opposite prediction on the new wage levels. This theory predicts that wages would drop. Okay, so what would be a story of declining demand for auditors? Just firms choose to hire fewer auditors at prevailing prices or at given prices. Why would they do that? I don't know, to save wages, to save wage costs. Maybe because of automation. To be clear, these are hypothetical theories, yes. Maybe it's because they have market power and they restrict the quantity. Maybe there's a leaky talent pipeline that auditors just choose halfway through before they become partners to jump ship and work at other firms. And that's too risky for the audit firms. AI technologies don't jump ship, right? So which one is it? Again, the difference between the supply and demand explanations are in the prediction on prices, whether they go up or down. So what happened? Well, can you click us to the next slide, please? All right. So to be clear, we don't precisely know. I will show you some data, but this is not the PCAOB data or anything, or data from the firms on what CPAs are paid at the Big Four or anything. What this is just FRED data. The red line is real wages of accountants normalized to 2009, that's here, compared to the normalized wages of financial analysts, that's in blue, and financial managers in green. So this is meant to capture the outside option of banking that the Wall Street Journal talks about. Okay, so what do we see? Well, what we see is that real wages have really stagnated over more than a decade, let's say, for accountants. In recent years, they have increased a bit, but indeed, precisely in the year that the audit quality went down, real wages went down. So they didn't keep up with the increases in inflation in auditing. And the next thing I want you to see is like compare that with the green line. Let's call that the bankers. It's not like auditing or accounting wages jumped significantly beyond, and I'll help interpret that in just a moment. So there's at most between 2020 and 2022 a 1.9% increase in wages, against with lots of disclaimers, not a huge wage increase. What does that mean? Well, again, that makes me doubt that the labor supply explanation is the entire story here, okay? So there's also anecdotal evidence, of course, that auditor wages worldwide are not competitive with alternatives outside the industry and simply didn't increase fast enough to be attractive. Here's Australia. EY audit pay does not even keep up with inflation. The Wall Street Journal says that people just want to join industries where they make significantly more for quantitatively minded students. Again, in positions compared with tech and banking. Banking we tried to capture on the previous slide. So low salaries, mundane tasks, burnout, and the threat of AI is what people list. So the interim summary here is just, look, it's hard to know whether it's demand or supply at this stage of the talk, but it's unlikely to be supply alone. Otherwise, auditor or accounting wages would have increased a lot more. Now, to make the statement precise, somebody would have to go and estimate labor demand functions in this industry. So that's a research opportunity. But more so, if labor supply in auditing decreased relative to the supply in finance, which is what the news articles say, then what we should see is that auditing wages or accounting wages increase by more than finance wages. And that we definitely don't see in the data, or anyways, not in the thread data. So that makes me quite doubtful that these stories capture the entire truth. So I want to be conservative here and just say, look, a loss of taste for accounting is not obviously the only explanation for the reduction in the number of CPAs, also known as the talent crisis. So, of course, better wage data is an important step to understand this, and we have some of that, so you should come talk and work with us to find out. But maybe we can make a bit more progress in the next few minutes still, investigating various alternative mechanisms. So, and I want to explain why that is important as well. So, look, if the talent crisis can have different causes, that also calls for different remedies. And the different remedies come by different actors, not all of which have something to do with what the PCAOB can do or has authority to do. That's why that's important to tease apart. So let me give you a non-exhaustive list of possible supply explanations. So that is, the auditors don't want to work in auditor anymore. So the juniors skipping auditing as a first step in a career, just jumping straight to their assistant to the CFO of an issuer kind of story would be one. And maybe they just jump to industry without requiring 150 credit hours, right? So that would make sense if in tech salaries are just so much higher in terms of levels. Second, of course, working conditions have changed post-pandemic, and maybe it is mind-numbing to sit in front of a computer doing auditing day in, day out. But again, this explanation would have to explain why this is more mind-numbing in auditing than in other industries, where the people go and also sit in front of a computer. But, you know, that's what it would have to be. Then it could be less valuable training. No? So maybe because in equilibrium, auditors jump ship, they don't get trained as well. Maybe training online is hard. Maybe learning from partners is harder online. Or maybe they just have a fear of automation. So I want to hint here at a potential parallel to the credit ratings industry 15 years ago. There is an established literature that suggests exactly that the talent shortage that this industry complained about 15 years ago and explain the decline in their quality might exactly be because people just jump into the next step earlier on. So I think that's an opportunity to explore the parallels and differences to that industry. You know, there are clearly differences. You need an audit, you don't need a credit rating, and so forth. So those are potential explanations for why labor supply may have decreased. But there's also potential explanations why labor demand might have decreased. So one is maybe the firms choose, given that people jump ship, to train their employees less, and that reduces productivity. And maybe training employees less also reduces quality. Okay, so that would jointly explain why people want to join less and quality is down at the same time. Now, hypothetically, if it was true that firms used more automation, that might reduce cost but also increase quality. I think there's a fair amount of disagreement out there about how much automation is actually used. This morning had a great Reuters article on that, being more doubtful about that. The explanation I want to take a deep dive in for the next few minutes is monopsony power in the labor market. Daniel is excited because he wrote a paper out there. Okay, so let's see. What is monopsony power? If I could get the next slide, please. I'm still unable to advance that. There's a good reason I switched from engineering to economics. Anyways, okay, so look, everybody knows the notion of monopoly power. So somebody has market power in the output market, in the product market. Monopsony power is market power in the input market. It doesn't have to be a monopolist in the input market. It can just be an oligopsony, so few firms competing for resources in the input market. So the usual demand and supply diagram is here. Here's a competitive wage for auditors. Here's a competitive quantity of auditors that the firms jointly demand at the competitive market price. But if one had a monopolist or an oligopsony with labor market power, what they will do is to equate the marginal revenue product of labor, which is this steeper line than the supply curve, and equate that with demand. And this is the quantity they will demand, but they'll only pay that wage that corresponds to, well, where auditors are willing to supply their labor. So they'll hire as many auditors as what is feasible at this new lower wage for auditors. Okay. The observation is that the equilibrium quantity and wages are lower than the competitive wage and quantity, simply because the firms optimally get away with that if they have monopsony power in the labor market. Now, how does that make sense of the news stories? Well, monopsony power can lead to perceptions of a shortage in the following sense. So for the prevailing wages, demand is higher than supply. Here's the wage, and there would be so much demand out there for labor, but actually firms only hire that much. Okay? So this theory can explain an imbalance, so to speak, for any given wage level with the number of auditors hired, actually hired, and the number of auditors required, so to speak, by auditing needs. So this call in the newspapers, this is a snippet from the Wall Street Journal article, to just pay them more, to retain people. Firms don't just need to raise salaries and offer training and so forth. So this call to pay them more falls on deaf ears because the firms already do what is optimal to maximize profits given the labor market they have. And they pay apparently too low wages to clear the market. So look, and of course, it's easy to see how perhaps having understaffed teams would also lead to a decline in audit quality. So that's the theory. The question is, wait, how does this align with the timing? Why would that have increased with the pandemic? Like, did labor market concentration increase through remote work? Looking again at Daniel here, who's done work on this, but one story one could tell is that more centralized wage setting and decision making by firms would just result in fewer competing hiring centers, so to speak. So that would generate a potential for less competition or more coordination and therefore lower wages. But of course, it could also be that at the same time that the labor market essentially becomes national or even international, the competition from outside the industry increases, no? So if the auditor that sits in New York City realizes they can also work for Google in San Francisco, during the pandemic, the outside option changes. And I'm going back to the point previously that if that's a story, then you would have seen the wages in accounting explode relative to the other wages, or the wage increases be much stronger. All right, so that's a bit of a framework to offer to say, well, this potentially is an explanation in theory, but the research opportunity is to figure out quantitatively how important is monopsony power to explain the talent crisis and its timing, and perhaps also the decline in audit quality. Now, here's some additional reasons why I think this could make sense. It is that Daniel's paper with various co-authors predicts that increased labor market power would reduce prices in the audit market, right? So the idea is that if I have lower costs on the input market, some of these cost reductions I will pass on to clients. And again, this is not data, this is an anecdote from, again, a few weeks ago, that the fees lagged inflation, whereas wages roughly kept up with inflation, so we're roughly flat. So I think, anyways, that theory fits the newspapers I read, but I'd prefer if it fit the data, so somebody should get on that. So finally, licensing rules, right? So I read in the newspapers, licensing restricts entry for workers. If one reads Friedman from half a century ago, he also points out this might not necessarily increase quality. There's also Journal of Political Economy level economic theory that predicts that if the industry sets licensing requirements in credence markets, one could call it, they will set licensing requirements too high from a social level, precisely in order to restrict the competition coming in. So that's just a profit maximizing thing to do. And indeed, the 150-hour rule is set by the state standard boards, not by the PCAOB. So yes, there are rules and regulations that prevent competition, but it's not the regulator that imposes them. And of course, there's evidence as well in the Journal of Accounting Research, copied down here, with empirical findings that are consistent with the notion that licensing requirements restrict the supply of entrants and do little to improve quality in the labor market. Last point I want to make is, does it, hypothetically, imagine it was true that the rules we set led to higher complexity of audits. I don't think they do. I don't think that's factually correct. But suppose it did. Does it make theoretical sense? And I don't think this can explain the talent crisis. I mean, look, I don't want to challenge the theorists in the room too much. Theorists can always come up with some complicated theory that makes a funny prediction, but the most straightforward prediction is that it cannot explain it. So look, why? Increased complexity, if it existed, would predict an increase in the demand for labor, right? You need more people to dig through these complicated rules. Well, if labor demand increased and so the demand curve shifted outward, that would predict both a higher number of auditors as well as a higher wages. And I mean, at least the higher number of auditors part is being clearly rejected by the data, and I would say the second one as well, based on the limited data we have. So second, when I read the newspapers and hear the analysts complain about why they leave auditing, it is the repetitive and mind-numbing work that is not particularly complex. So if anything, that could make the job more interesting and less automatable, right? That would increase labor supply. What would that predict? Well, if labor supply increased, that would also predict an increase in the number of auditors in equilibrium, which is not what you see in the data. So I think aside from just not having a factual basis, I believe, it just doesn't make theoretical sense to ascribe the talent crisis to increased complexity, neither in a supply or demand story. So I think this is unlikely to be explanation. Okay, so the conclusion is that I would encourage people to think carefully about whether it's supply or demand that leads to the talent crisis. I think that news stories we read just fail to acknowledge that this is an equilibrium phenomenon, that at prevailing wages, the auditors don't want to work in auditing. But labor demand probably plays an important role for that. And none of the factors I just listened, when you think to them, none of that is under the remit of the PCAOB. But I think distinguishing the explanations is important for the industry, and audit quality, and will have an impact. in academia and outside. So that is just a framework and some thoughts on the talent crisis and audit quality. I want to spend the last few minutes thinking about other research topics that I personally believe would be interesting. So one is audit demand modeling. So modeling audit demand would be helpful because for any rule or new standard we pass, which might serve as a shock, you could think, knowing exactly what the demand is would help predict the effect of the supply side changes that we make to the provision of audits. So this would be fantastically useful, and of course, modern I/O methods would lend themselves nicely and be a technological innovation perhaps as well. So I would think that the journals would have taste for that as well. The second part is measuring demand for inspections and PCAOB data as well as enforcement. Right? So when you think about what incentives the firms have to provide quality, it seems that PCAOB enforcement is at least a very important component of that. You also see that the firms use the PCAOB label in their marketing materials. Okay, so clearly it's valuable to them that we oversee them. It seems to suggest that the quality is higher, or that's what they seem to perceive. But the question is, how valuable is it? Can we quantify that? So I think that's an important question. Second, there's lots of demand for the information that Harsha's team makes available on our website. So clearly it's valuable. The question is how valuable? So those are quantitative answers that I think are important to address. I think the lowest hanging fruit might be studying market reactions of the issuers to disclosures of inspection results and enforcement actions. Right? So this would measure the direct value of PCAOB inspections and enforcement, and that's public data, right? So as soon as they come out and hit the market, one can just study the reactions of the issuers. I want to be clear, the indirect value of the program is probably much, much, much higher, no? Because it just increases the trust in the overall capital market that there is somebody out there policing. But just to make baby steps towards measuring the value of these programs, I think studying market reactions would be a good idea. And I have thought about a few designs that we can discuss. So finally, estimating the marginal benefit of an inspection would be helpful, because as long as the marginal benefit exceeds the marginal cost, one would think that maybe we should inspect more or less, who knows. But at least it would help us approach an answer to the question what the optimal number of inspections is. And I think that would be important as well. The third and last set of categories I think would be important to understand better is auditor incentives. So in particular, the incentives to compete on quality, and I think there's scope both in theoretical modeling and empirical work to understand this better. One particular subset of questions would be if there's a segmented market between different types of auditors, some of which essentially trade off quality with reputational gains. Okay? And what would be important to understand is what the career consequences and monetary consequences are for these firms, partners, and issuers that would help us understand more broadly what auditor incentives are. So those are a few of the topics. Again, we look forward to chatting with you over the next few days about those and other areas that you might think are interesting. That's what I have for today. Thank you very much for your attention.